Hey guys, Dan Frio here on the Mortgage Update, and it is August 19th, 2019, and I apologize, it's another late video after hours. It's 9 o'clock my time in Chicago, but let's get to it. What happened today? Well, the stock market went up pretty big, and you'll notice right in here, up 250 points. So a big day in the stock market. So what normally happens in a normal market, if Trump doesn't tweet something crazy, we run in patterns. Okay, so what happens in this case is if the stock market goes way up, normally it's taking money from some avenues, and it's usually taking money from bonds. Okay, and what mortgage rates are determined by are mortgage-backed securities. So if you follow my channel, you know that. Okay, so that's what we're going to talk about right now. So the stock market went up good, over almost 250 points today, but the mortgage-backed security market got pounded. And those who follow the channel, again, 0.0, 0 to 0.567, you're not going to really see any changes in the market. But once we get up above 10, 15, 20, you're going to see a change in the market. So down 22 is bad. Okay, so here's how we follow this, and follow along with me, especially those who follow daily. When this number is going down, rates are going up. And the more this number goes down, the more rates are going up. So it's an inverse relationship. So basically what this is a mortgage-backed security. It's a bond. So the higher the price you pay for that bond, you're getting a lower yield. So let me make it make sense. If you buy a $100 bond, okay, and it has a big yield, you might pay $50 for that bond, and then as it matures, it'll be worth that $100. So if you're paying $50 now, and it's going to be $100 in X amount of years, you can factor in and figure out what interest rate it's paying you to get to the $100. So that's a big spread. So your interest rate has to be pretty big. But let's say you're paying $99 for a $100 bond. I mean, that's 1% that you're going to get you up to $100. So the yield there is bad. So again, the more money you pay for a bond, the lower the yield is going to be. Okay, so that's basically how all of this works. So again, unless Trump kind of tweets something or something kind of really odd in the market takes place, everything runs in normally a pattern. Okay, and that's why we follow on this. With me, we follow the Fibonacci levels. So what that does is it gives us floors and ceilings on different things. So at one point we had the floor here, the ceiling here. We knew it was going to run through here for a while. It eventually breaks out, and then it develops a new floor and ceiling. So right here we peaked over this, thus creating another ceiling. So this was the floor, this was the ceiling. Now this is the floor, this is the ceiling. So you see how we're running in patterns. Okay, so those patterns can run for a long time. But, when it breaks out, then we do something. So normally when it breaks, like when it broke through here, my assumption was that the rates were going to stabilize and maybe move back in this pattern again. It didn't. But the nice thing is it didn't really move that much. So my clients might have missed out on maybe a 0.1 adjustment in interest rates. Nothing major. The other thing is, I always try to deal on the side of caution, because it could have went down just as quick, or we could be down here, and that move would have been, I think, a little bit more devastating than it going up. Let me make it make sense. I'd rather my clients lose out on a 0.1 interest rate, so I say, I'll get you 3.99, I get you 4, versus or I got you 4 instead of the 3.99, versus me calling you up and saying I'm getting you 4, and now it's 4.375. So I hope that makes sense to you. Okay, so I think we have a new floor in place. The issue we're going to have this week is there's really no news out until Wednesday. The Federal Reserve is going to give us their minutes on Wednesday to tell us what their forecasts are and just the verbiage of what they're looking to do in the future. I don't really see a major change there. What the big news is going to be this week is a lot of the bigwigs, a lot of the financial players are going to be in Jackson Hole this weekend, Thursday, and they're going to discuss everything that's going on behind the scenes. This is all where all the money is. These are the big power players, and they're going to come out of there and they're going to post their information to us to let us know what their thinking is. Big businesses are going to say, are they planning on hiring, stop hiring, starting letting go? How's shipments? How's future sales? How's all of that going? The Fed is actually going to, behind doors, kind of explain their positions to all these financial players too. All that news will trickle out, to us. That'll be the biggest key of the market. What are companies doing? What's the Fed really going to do down the road? That's what dictates everything. So again, today there's really no news. We've created basically a new pattern here. I'm saying that it's going to trickle on here at least till Thursday. So I see nothing really changing. So if you're buying a house, if you haven't locked yet, just keep floating. If you're a mortgage person out there, a real estate person out there, I wouldn't advise your clients locking yet. But that can change pretty quick. And again, I will post an alert video if I see a day that we're getting clobbered, and I suggest you lock. Now, why didn't I post today? Well, this week's going to be volatile up until the Thursday meeting. So, unless this thing really falls off the charts, I'm going to say hold on for a minute, because I think everything's going to come back and come back in line, and we're going to start testing these levels again. Again, up is good because it drives down yields. So I hope this makes sense. The other piece of the equation that we follow is the bond market. Okay, and you'll see in here when this pops up that we hit the Fibonacci levels of this. This was a floor, that was a ceiling. Now we've created a new, then there was a short-term floor here. Now we just hit another floor. We just created another floor here. Again, I said that we're not going to go in a straight line. I don't see this continuing. That is a huge move in bond yields, and I'm predicting that we're going to end up in the 1.6 to 1.7 range here in the next week or so. Let me just conclude this. And I go into a little more detail. So if you're in the mortgage profession or you're really into this, you kind of get a lot of what I'm saying. If you don't, I try to make it as simple as I can. Basically saying right now until Thursday, don't lock, don't do anything. The news coming out, we're in a good trading range with mortgage-backed securities. We're right in the middle of the new floor and the new ceiling. So we're right in the middle of it. So we're going to either go down just a little bit or up just a little bit. I don't see any extremes any which way. And but Thursday, please tune in on Thursday, and I'll give you the scoop of what the future looks like. And that's gonna be basically a crystal ball from not only the Fed but big businesses. So I hope you liked the video. Again, thank you so much. If I can be of any help, just to let you guys know, I am a mortgage lender, a mortgage advisor. I help a lot of people with their credit, and if I can help you, if you're anywhere in the country, please reach out to me. I have an 800 number. I'd love to help. It's 844-775-LOAN, which that is in numeric numbers is 5626. Or you can reach me at dfrio, which is FRIO, at parksidelending.com, or you can find me on the web at themortgageupdate.net. God bless. Have a great night. See you tomorrow. And I will be back tomorrow. I got nothing going on tomorrow. Take care. See ya.